Hello, everyone, and welcome back to another episode of Let's Talk Real. I'm your hostess, Maine, and here with me is Kelly. Hi, Kelly.
Hi, how are you?
I'm great, great. I'm actually excited because we're like changing things up now. Every day of the week, every week we're doing a different day now.
Right.
Hopefully, everybody's keeping track of us. So today we're going to be talking about Mortgage 101, all you need to know to understand how it works, what it is, how it comes to be, who can qualify for what, and how it's determined. So Kelly's going to be giving us some pretty amazing insights into the world of mortgage. And if you guys have any questions, please don't hesitate to send us questions here in the comment section. Whatever you are watching from, just send questions that we can answer to you as we move along. So starting with the myth of the day, as usual, we were kind of like thinking about what kind of different myths we could bring it to you guys today. But we decided to bring this one in, which is you cannot pay your mortgage off early. So Kelly, can you give us a little bit of insight into that common myth that people don't really understand?
So in essence, like I want to say yes and no, you can. So in reference to that, one of the big things is like when you purchase a home, for most people these days, your home should be the last thing that you're looking to pay off. It's not like buying a car, because a car you only have usually 5 to 7 years with amortization and paying that off. And you can pay it down, which can reduce your term on the loan. So on a 30-year mortgage, if you pay one extra principal and interest payment on your mortgage a year, that will reduce your years by 7, which helps you in paying off early. And also to refinancing, people refinance all the time. You can refinance into a shorter term. When you refinance into a shorter term and you put that extra payment on a year, it doesn't reduce it by as much as the 7 years, but it does reduce it. So in essence, paying off your mortgage is a thing, but it's, paying off early. There's a lot of different things you have to look into when paying off a mortgage. And, a lot of people, my husband is one of them, has a mindset that he just wants to pay it off. And I'm like, it should be the last thing, like, cause you always have equity,
right? So
it should be just one of the last things you worry about
paying
off when it comes to paying off debt. So I would say that's one of the biggest things.
Yeah, and I think one thing that we can chime into that is that normally a mortgage is going to be one of the financing, the cheapest financing you're going to have among other ones. So car most likely might be higher. It might be about the same, but most likely higher because you have more interest in a very short period of time. So ideally, you want to try to pay that off early. But when you look at the mortgage, it's really a 30-year, maybe 15-year, but it's a longer commitment, and that interest rate, even if you get a 6 or 7 like right now, that's still pretty small and lower in comparison to other loans that you may be getting. So but the big myth is that people think that they are not allowed to pay off, that there's some sort of pre-penalty payment fee. There could be, so I always check with your lender, but majority of times that is not the case. You can just pay off your mortgage at any time. And I think another thing that I hear from my clients too is that they think, okay, I'll pay off my mortgage, but that means I have to pay off the interest for the 30-year commitment that I did. And that's not true.
Correct.
So from the time you actually pay off your mortgage, you're paying off the principal, which is the actual financed amount, but you don't have to pay the remainder interest that would, come from those following years. So you actually take advantage of paying it off early. And like Kelly mentioned, making additional payments on your mortgage actually can help you. And I say additional payments towards principal, so make sure you're doing that. But those can actually take a few years off your loan overall, so you can really benefit from that and get rid of that interest that you would be incurring if you only pay exactly the amount you have for the 30-year.
Correct. Yeah.
I think that's really explains really well about the Smith. Hopefully, nobody else has questions on that.
Yeah, and
Um,
a lot of people don't know that paying that extra payment a year can reduce it. So if you get a bonus at the end of the year, and you have a little bit extra savings, putting that down on it will definitely help.
yeah, it goes a long way, a
Mhm.
very very long way. So today we are like we said we're going to be talking about Mortgage 101, and we are going to be going over from basics to more in depth. But let's get started to what is a mortgage? Tell us, Kelly.
So a mortgage is pretty basic. It is a loan that's used to finance a home. Um, and most are for 30 years, but you can do a 10-year, 15, 20, 25, and a 30. So it's really all what your particular profile fits into. There are a lot of people involved. So you have your lender, the borrower, the person purchasing the house, the person selling the house. You have your title company, your realtor, unless you sell by owner, you have your
Mhm.
realtor. Um, I think that covers it for the people that
Yeah.
are involved. But with a loan, you have your loan, you have your term, you have your rate, you have your different products. There's a lot of different things that go into a mortgage, but it's basically a loan to purchase a home.
Yeah, and I think one of the, I think more important things and characteristics of a mortgage would be that the the mortgage is used to purchase a property, but that's because the property is used as what they call a collateral of the bank, right?
Yep.
So the reason why the bank is willing to give someone so much money to purchase a property is really because they use that property as a collateral in case the buyer forfeits payment. The bank actually takes the property back as the collateral for that loan amount. And that's when we hear about the foreclosure portion process that people are always asking about is when a buyer can no longer make payments, the bank takes the property back, and that's a foreclosed property. But I think that's a big characteristics of the mortgage too.
Yep.
Yep. Okay, so let's get into how does it actually work. Um, Tell us a little bit more about that.
Okay. So you're given a loan, obviously, and basically you have your loan amount, your down payment, and your interest rate. So the interest and the term of the loan with the loan amount determines your payment. Um, and it's paid monthly. For most mortgage companies, it's due on the first of the month. And then you're always given a 15-day grace period. That doesn't mean you send your payment in on the 15th.
Please don't do that.
It means if you don't get it in by the first, you have that 15-day period
Great period.
to pay it online. And a loan can be obtained through a mortgage company or bank or like some type of lender that is able to put a lien on the property. So basically that's what it is. It's a loan that you pay monthly or bi-weekly. A lot of times, either we don't necessarily have bi-weekly products anymore, but once your loan closes and you go into servicing, sometimes you can have it set up that you pay bi-weekly on your mortgage, which if you pay bi-weekly, that can help pay down your mortgage sooner than the 30 years.
Yes,
Because
because I think we have like an extra week or something.
yeah,
right?
there's like an extra because there's so many months out of the year that you have like you get paid. Like there's 5 months or 5 weeks out of not 5 full weeks, but 5 weeks that you get a payment in. So if it's bi-weekly, you get that extra payment in there.
Yeah.
So,
And then he kind of tricks the mortgage to think you made an extra payment.
correct. So I know that can be set up. You can sometimes have that set up with your servicer after you close. You want to do like online payments and you wanted to do twice a month. I believe you can have that set up.
Yeah, that's right. And then for the mortgage itself, like on the process of how it works,
Mhm.
what is the lender looking for when they are trying to approve that buyer? What are some things that they are actually looking for?
So they're going to be looking at how much you're looking to put down, the area that you're looking to purchase in. Are you a first-time home buyer? Is this your forever home or is it your starter home? Is it your retirement home?
Mhm.
Um, So they want to see that. They want to look at credit. They want to see where your credit stands. They're pretty much going to look at you, your whole profile, as that's our job to find out about you. Like a borrower always tells the lender different stories than the realtor.
Yes.
But as a lender,
we know that for a fact.
we need to know, as a lender, we need to know everything. We need to know, because we need to know what box to fit you in.
Yeah, basically. Yeah, and that's very important, because that's going to help us determine the different types of mortgage you can get. So tell us a little bit more about all the different types of mortgage a buyer could potentially qualify for.
So the most popular is the conventional loan. Conventional, you can put, excuse me, starting at 3% down, all the way to pretty much whatever percentage you want to put down. If you put more than 20% down, then you don't have mortgage insurance. So right now in this market, conventional is definitely the most popular, because people, they want a good borrower, and a good borrower is going to be in a conventional loan. But we also have our government loans, which is FHA and USDA and VA. Not to say that those borrowers are not good borrowers, but the government is not as strict on the borrower as they are on the property. Excuse me. So the government can be very strict. The property has to be up to par. So, but again, those particular government loans go to a lot of first-time home buyers or veterans. They're not necessarily a first-time home buyer, but they're looking to put, zero money down. Yeah. That's kind of a benefit for that. So we have the government loans. There are construction loans. Construction, we do end loan constructions, but with a construction loan, there are some companies that do one-time construction where they close up front and everything's based on the appraised value of that end product. Yeah. I do have a couple contacts, a couple lenders that still do one-time construction loans. That's what I used to do when I got in the mortgage business.
Yeah. And just to break it down, that one too, because a lot of people get very confused with the whole new construction, right? Mm-hmm. So when we say a one-time settlement up front, we're talking about, like, let's say you're looking to buy land and build. Mm-hmm. You can actually have a one-time construction loan set up where they're going to take the amount of the land amount, purchase the land, but they're also going to add the construction amount needed to build the home and do a one-time lump sum closing based on the overall amount.
The overall value. It's usually based on, so an appraisal would be done based on the contracts from the builder plus the land, and they do an appraisal based on that information, and then they lend on that appraised value. Right. It's usually how it works, but as far as the criteria that goes into it, it's kind of the same as if you're purchasing a home, but it's based on a home that's not there yet.
Right.
But with construction loans, I always recommend people add 10% into your loan amount, because when you're building, you are always going to go over.
Yeah.
Almost guarantee my borrowers would go over, and I'd end up refinancing them because they needed more money because they made changes throughout the process. It happens all the time. And with a one-time close, during the construction process, there's usually an interest-only period as draws are being made on the property as the property is being built. So that's something else to keep in mind. Depending on the builder and who their lender is, all depends on whether you have that piece of it or not. But in most cases, there is a construction period where you pay interest only on the draws that are being done.
And you can also be making payment. You most likely will be making payment on interest, but also on taxes. And the taxes are usually estimated at the total value that you are actually making your financing on, but you won't be the actual taxes until you get the house is built and a final appraisal is done on the property to determine the assessed value of the township where the house was built.
Correct.
So a lot of people sometimes don't realize that, because the taxes will seem a lot higher, most likely, at first for that first year because they are prepaying based on the total value. But the assessment usually is lower for tax purposes, and then they're probably going to get some money back after the first year when the house is being built.
Yeah, they'll put it, like we talked about last week, they'll put that like into an escrow.
Exactly.
And get refunded. So that's pretty much the basics. And there is also, and I don't want to get too in depth because it could get confusing, but like we offer PHFA. But PHFA, you can use PHFA with a conventional, with an FHA, with a USDA, with a VA. The PHFA piece of it is the piece that gives the money to the borrower to help with down payment and closing costs. So you can have a PHFA loan, but it's also could be in one of those criteria.
It could be a conventional loan under the PHFA program or a VA loan under the PHFA.
Correct.
Yeah. Correct. Yeah. And then to clarify too, and we will be doing an episode just to talk about PHFA because it's a very popular, very high demand right now from buyers program, because it gives the buyer 5% of whatever the purchase price they're going for back to them as closing cost assistance. And it's a guaranteed credit. It's a forgivable type of grant as soon as you meet certain criteria, which we will explain on our episode about it. So stay tuned to our PHFA episode. But basically, you can have any type of mortgage under the PHFA program as soon as you qualify for the program yourself. And we'll go in detail next time we talk about it.
Yes.
Alrighty. So are you good with the types of mortgage then?
Yep.
Did you mention about the portfolio? I didn't even.
Oh, I didn't. Okay. So there also is a portfolio type, and portfolio is for people who are way outside the box. And not every lender has portfolio products. It all depends on the customer and what they're looking to do. But a portfolio product is something that they kind of just fits into a smaller box versus these other types. And again, I can't really even think of an example of one, but there are portfolio loans that, maybe they have like a high income, but their credit score isn't the best. Like there's certain things that can go into portfolio loan, but only certain banks can offer those portfolio loans, but it is a thing. So
yeah. Okay. Alrighty. So how do the mortgage rates work, and what necessarily determines then? What's the process in that?
So interest rates are pretty much based off of the market, determines what the interest rate is. So when the US dollar is strong, rates, when the US dollar, let me make sure I have this right. When the US dollar is strong, the rates go down. When the US dollar is weak, then the rates, do I have that right? When the US dollar is strong, yes. When the US dollar is strong, rates will fall.
Yeah, it's usually
when the US dollar is weak, the rates will go up. So right now, as interest rates are rising, the US dollar is weak right now. And that's kind of how the market is working. It's Ken really explained it really well when we interviewed him a few weeks back.
Yeah.
So if you really want to know, you need to watch that episode because he really gave a good explanation as to why our interest rates went down so much back in COVID, and now they're coming back up again.
Yeah, that's the Fairway episode. If anybody is wondering, we had the owner, the branch owner, can come and talk to us a little bit about, Fairway, but the market itself. So if you want to get some very experienced insight, that was a really good episode.
He gave a really good explanation as to how the interest rates are working. So as far as interest rates on you as a borrower, a lot of people call me and ask me, well, somebody asked me yesterday, what is the interest rate on a 30-year mortgage? I'm like, well, I can't really say it's this. I can give you a range. and I said it could be right now between 6.5 and 7.5. The reason I can't say, and I've never in my whole 20 years of being in finance, I could never say, well, this is what your interest rate is going to be. It always has to be a range because it's going to depend on you. It's going to depend on how much money you're looking to put down, what your credit score is. Did you own a home before? Are you a first-time home buyer?
The debt to income ratio.
Debt to income ratio. Like there's so many things that go into play with the interest rate. And honestly, when I priced one the other day, and they were putting the interest rate was better if they put less down than if they put 20% down or more.
Interesting.
I know. I thought the same thing. So the shorter the term that you're looking to go into, the lower your interest rate.
And that's something a big factor there, right?
Yeah. So a term has a lot to do with it. If you're looking to go into usually a 25-year, 20 to 30 year, those interest rates are pretty equal. But if you get less than that, then the interest rate usually does seem to get a little bit better. And you see a lot of people going into those types of terms, the shorter terms in a refinance versus a purchase. So again, and the rates change every day. Sometimes they change twice a day. So they change twice today. So sometimes they get better, sometimes they get worse. It all depends on the market that day.
Yeah. So. And interest rates are something that is publicly marketed and works a lot to make a comparison. If anything, it works a lot like a stocks. If they are putting out stocks at a certain price, the interest rates are similar. You have companies like financial companies out there, they may be looking for a specific type of buyer. They want a buyer, let's say, that has 680 to 700 and with a 38% debt to income ratio, first time home buyer. And they may be offering a specific rate for that specific type of buyer. And it may be higher or lower than another different type of buyer. But that's all like in the market. And you as the lender have the ability to shop. Some lenders do, some lenders don't, but you have the ability to shop around to see what the best rate would be for that specific type of buyer. And that's why you can never tell a buyer, oh, it's X amount, because it depends on what's being offered in the market for the interest rates available for that day at that time for that type of buyer. So there's so many variables.
Yep. And interest rates you can only, like the interest rates are Monday through Friday. The interest rates do not change over the weekend. So if I want to price a loan on the weekend, it's going to be whatever the rates were on Friday. So, and that's pretty much with any lender. Rates are not generated anywhere on a Saturday or Sunday.
Nice. That's good to know. So whatever is Friday by end of day, that's what's going to be for now the whole weekend plus the morning and 2. A new rate comes out.
Yeah, whenever the rates come out, and it varies the time, but it's usually 10:30ish is when the rates come out and on a Monday or any day.
So yeah, again, it works a lot like stocks because stocks is the same way. So yeah, just keep that in mind, guys. So let's go into the mortgage pre-approval. What is it? What is an actual pre-approval? Let's put it that way, because the misconception between pre-qualification. So tell us about that and explain us what the pre-approval is and why it's different.
Yeah, so the difference is, so pre-approval is we pull your credit, we look at your debt versus your income, and we get the supporting documentation to show, and that supporting documentation will be pay stubs from your last 30 days, your most recent W-2 or the past 2 years W-2. If you're self-employed, we get 2 years returns, and we do an average of what the income is. So an actual pre-approval, we have an automated underwriting system that our underwriters use, that we use to do the pre-approval. We put all the information in, we verify it with the documents that are provided by the borrower. And with that being said, that is what an official pre-approval is. Fairway does have And a lot of mortgage companies have this where you can actually get, I believe it's called like the Fairway Advantage, where we collect everything up front, like from soup to nuts, from that we can actually give an actual approval, because there's a difference between a pre-approval and an actual approval. So we say you have somebody that, that they just want to be ready to go. When they find the house, they want the approval. We can actually do that. We can collect all the documents, send it through our underwriters, and then when they go to look at a house, they actually have an approval in their hand.
Yeah, and that's what we call it, the underwriting approval, correct? That has been done through the underwriter.
Actually looked at that file, reviewed it all, and it's an actual approval.
Yeah.
But the difference, so then there's also a pre-qualification.
Yeah.
So pre-qualification, you kind of get an estimate from your borrower, like, okay, what do you think your credit score is? What is your, like, not everything is verified. It's much less formal. So, as a realtor or somebody's working with somebody, if they say a pre-qualification, it's always good to say, well, what was all involved with your pre-qualification? Did you give your documentation? Just, especially in this market, you don't want to have a pre-qualification and then they go through and they pull credit and they look at it, and nothing is what it actually seems.
Yeah. So, and just to clarify too, like a pre-qualification in today's market is not accepted.
Yeah.
They are not even looking at offers from a buyer that is not at least pre-approved, because pre-qualification is really just so like, hey, I talked to a bank, I think I can qualify based on what I told them, but there's no guarantees. A pre-approval could also not be fully done, right? You could still fall through, but at least there's verification on documentation. There's more certainty that deal will go through. And then the actual underwriting approval would be like, okay, this guy is definitely closing no matter what. And it gives that assurance to the potential seller that that buyer can purchase the property. So no pre-qualifications in today's market.
Correct. So yeah, that about sums it up for a pre-approval.
Okay. And we kind of already chimed into this one. Why do you need it, right? So I think I actually touched base on this one because, like I said, today's market, it's a very competitive market. And I believe even before this market became such a strong market for the sellers, we still require the pre-approval, because the pre-qualification, again, is really just someone saying, hey, I make this much money, I have about this much debt, and I think my credit score is this. But who knows, right? It could be accurate, it could be very inaccurate, it could be missing information. There's a lot of things that nuances, things that could come up that the lender needs to know, and then could jeopardize that buyer to purchase. So a pre-approval has always been a requirement overall. But now, especially in this market more than ever, you need to have a pre-approval to even look at some homes. Some sellers, agents may not even allow you to book a showing if you don't provide a pre-approval letter from a lender. So that's why you do need to have a pre-approval at least in order to start shopping. And then you can give us some other reasons why too in the financing portion, right, Kelly? Why is it important to have a pre-approval before start shopping for a home?
Because you just never know. Especially like with self-employed borrowers, we need to get all of their tax returns, and we kind of call it old school, like collecting these 2 years worth of stuff. But even if my automated underwriting says only 1 year of W-2s needed, I always collect 2 years, because we're always going to need a 2-year history of your employment, and which requires your 2 years most recent W-2s. But it really solidifies the deal, especially if I'm competing with somebody else who has a pre-qualification. Well, here's my pre-approval, here's my fee estimate, and I got all the criteria that provided the correct information for the pre-approval. So it's very important when it comes to competing against other lenders and stuff, because I have it all. Like it won't take much longer to get the loan done once they get somebody under contract, because I've already collected everything.
Yeah.
So it's super important to have all that stuff.
And I think on the education piece too, because when you get a pre-approval, I know you do this to all of our buyers. You provide a cost sheet, so that buyer now, with a pre-qualification, you don't get that, but with a pre-approval, you know exactly what your estimated monthly payment is going to be, what your estimated total is going to be. Kelly will make sure that you have the funds to cover that total. So you as a buyer also comes into the shopping arena of homes, that knowing exactly what you can afford, how much your payment's going to be. And sometimes with a pre-qualification, a lot of buyers, and sometimes no, a lot of them come to me with a pre-qualification, not understanding, hey, I'm approved for $500,000 home. But they don't understand that $500,000 home is going to be over $3,000 monthly payment. And they're like, wait a minute, I don't want that. So that knowledge is also important. And
that's a big one.
That is a big one. People don't think about that. It's not just, hey, can you approve? No, maybe you can. It can even more than what you want to spend. And that's what you need to understand. How much do you actually want to spend, and what your monthly payment, what is your desired monthly payment? Mm-hmm. So we can determine what your purchase price is going to be. We have to kind of work backwards, and the pre-approval help us determine that for you. So you are also a more educated buyer. And I think that's a huge one. Yeah.
Yes, absolutely.
Okay, so within the mortgage, there's also some limits, right? So tell us what they are and what are some options in case a buyer is in the limit.
Yes. So there are actually loan limits and there's income limits. So with loan limits, so the conforming loan amount, which is quite high these days, which is actually $726,200. I remember there was a time when it was like in the 200,000s. That was many years ago. But so that's
inflation for you.
Yeah. So that's a 1 unit. A 2 unit is $929,850. A 3 unit is $1,123,900, and a 4 unit is $1,396,800. So these are loan limits, not income limits. So they all these loan limits fall within like the conforming and the different conforming loans. So with FHA and the USDA and all them, they also have loan limits, which are much lower than what these numbers are. I don't have all those broken out into what they are, but there is a limit in each one. But what also goes into that, and even with some conforming loans, are income limits. So with USDA, for example, we don't always know what the loan limit is until we get all the criterion, because that depends on the household.
Yeah.
And with USDA, it includes the household is every person living in that house.
Even if they're not in a mortgage.
Correct. And they have to include all the income of everyone living in that house. Even if they're not on the loan, they still need to count their income with USDA. However, there is a first-time homebuyer program with conforming, which is 3% down. So with the 3% down, it's home ready or home possible. We can lend up to 80% of the average minimum or average, excuse me, the average income for the county. So the ACI, so the average county income. So every county in PA has a different income limit. And with Home Possible and Home Ready, we can lend up to 80% of that amount. However, conforming Fannie also has 3% down that will lend up to 100% of that loan limit in those counties. It's not, you don't fall under the Home Possible and Home Ready, but it's just the 3%. Like Fannie itself you can get that loan with 3% down, and we can lend up to 100% of that loan limit.
Mm-hmm.
So with the Home Ready and the Home Possible, there are first-time homebuyer classes that you have to take, whereas you don't if you're just going to do the 3% down. But 3% down is a great product for first-time home
It
buyers.
really is, yeah. I mean, it's better than the FHA, which is commonly known for used for first-time home buyers, which is 3.5. So
Correct.
it's really
Yes,
good.
and the big thing about FHA is FHA. The reason why it's so popular for first-time home buyers is there are a lot of products you can use with FHA, like getting grants. A lot of the grant programs that you're able to get grant money, you have to have an FHA loan. Like they're usually a government thing
Yeah.
that you get.
And you can get
So
up to 50% seller's assistance. You
Yep.
also have very flexible guidelines for the buyer itself. Like they can have a higher debt to income ratio. So it's a little more easygoing on the buyer. And
Yes.
that's why it's so commonly used.
And that's the big help with FHAs. They're very lenient on the borrower and their credit history. But again, the loan limits, some other loan limits are within, like I'll use Tenfold as an example. Tenfold is in York County and Lancaster County. And there are loan limits in there, but there are also income limits in there. So you're restricted, and that depends on the household too. They don't count all. They do count all household income for that as well. But the limits, like the income limits, increase as the more people are living in the house.
It's a little more flexible there.
Correct. So, but that's just another example of a loan limit and an income limit, because it falls into play. So that just kind of sums it up with a mortgage. Each mortgage and each product has its own criteria that you have to follow. And that's why me as the lender needs to find out about you and your background, what you're looking for, to see what would be the right product to fit you in. But because we could probably go on and on and on forever about all the different things with the mortgage, but this pretty much covers the basics.
Yeah.
Do you have any questions?
Yeah, so we did get one question, and they were asking, what if the house happens to be higher than the loan limit? What are the options available?
Like the purchase price of the house?
Yeah, they were saying, what if it's above 700 and some thousand, I think you said. They said, what if it's above that? What are loan options available? I think that would fall into the jumbo loans.
It would fall into, so it's not, so the conforming loan limit. My screen just went back.
There it goes.
Conforming loan limits, that is what those numbers are. Not every loan is a conforming loan, if that answers it. So there are jumbo loans. So if the loan ends up being higher than that $726,000 for a single unit, you would just get bumped into a jumbo loan. And we have products for them as well.
Okay. So, yeah, that should answer. So basically, you're just going to need a different type of loan, not a conforming loan, a jumbo loan to purchase a home or something.
Yep. And conforming is just kind of that word that they've always used for the conforming loan amount. It gets higher and higher every year. Like I said, 20 years ago when I get into it, it was in the 200 some. I don't remember exactly what it was, because that was
now it's 726.
But that number has increased quite a bit over the years.
Yeah, so have different house prices.
Exactly.
Yeah.
So,
that should summarize. I think that's the only question I saw coming in. Do you have anything else, like in particular, that you want to share in regards to mortgage that we maybe didn't touch base?
Let's see if I have any other notes. Maybe just some other things that we look at, like, what salary is needed. There are some common questions. Well, it's not that you need a particular salary, it's just necessarily a particular income. And, every product is different, so it all depends on which product that person would fit into. Another question is what are good mortgage terms? Well, the good mortgage terms are all going to depend on you and what you're looking for, but the normal mortgage term is a 30-year fixed mortgage. That's
the most common. Yeah. And I mean, people have to think that with the 30-year, majority of people fall under that because, of course, you're stretching that principal, that purchase price to the 30 years, so your monthly payments are X. But if you do a 15-year term, of course, your monthly payments are going to be higher. So you really depend on the person's finances and ability to pay a higher monthly payment. Sometimes they may prefer because they want to just be able to get rid of the property payments sooner. But sometimes it actually may be more cost effective to go on a 30-year and make additional payments because they might end up paying sooner than 15 years if they actually make additional payments. But they won't have to if they can't afford to. And I think that's one of the reasons people go for 30.
And one of the other biggest questions is, what is mortgage insurance?
Oh, that's another one. Yeah.
I believe we
have some explanations on an episode. Yeah. I think we're the closing costs episode.
Yeah. And mortgage insurance is something that you pay to the mortgage or bank that insures the bank that if you were to go into default on your loan, they're protected. And that is only if you put less than 20% down on your loan. So that's pretty much what mortgage insurance is. It insures the lender.
Yeah. And the more you put down, the less you pay until you reach that 20% and you don't pay anything at all. So that's a good one. And then there's also additional mortgage premium whenever you use a government funded or government backed loan like FHA. You have the FHA mortgage premium. For VA, you have the VA funding fee. USDA also has a mortgage premium there.
They have USDA is 1%.
Okay.
Yep.
Yeah. So those are commonly there. And this is just a curiosity. We have mentioned this before, but I want to bring it up since we're talking mortgage. Whenever you buy a home, your first mortgage payment will always skip the following month. So you're closing like March now. Closing March, your first mortgage payment will skip April and be May. And it doesn't matter what day of the month you close, because if you close on the first of that month, it still is going to skip the next month and be on the following one. So some people sometimes prefer to close on the first or closer to the beginning of the month. That way they have a bigger stretch without payment. But you also pay more prorated taxes because you have more days within that month.
Correct.
And I think you mentioned about that too, right?
Yes. But the reason that is because they collect it all at settlement. So they actually collect that's part of end up being your closing costs. It's like the prorated amount and then the following month, and then your first payment's due on that. So like we're in March. So if you closed in March, we collect for the rest of March and April, and then your first payment's due in May.
Yeah, so people think they're not paying, but they are. It just feels like you're having a little bit of a break.
Correct.
The bank is not that silly. But yeah, a lot of people don't know that, because especially when you're trying to time it, like leaving a rental, right? A lot of people don't know that they have like that month break. So just to keep that in mind, like if you are buying a house in March, closing in March, but you're still staying in your rental in April, you don't have to worry about having to make two payments, because April goes away and starting in May. So that helps a lot of people. I know that. I can't think of anything else unless you can think of something.
I don't think so. I kind of jotted down some FAQs that I actually Googled just to see, but I think the biggest one was a mortgage insurance.
Yeah, that's true.
I think that sums it up with what a mortgage is.
Awesome. Yeah, so that was it. That's Mortgage 101. Hopefully you guys y'all got a better understanding of what mortgage is and how it's determined, how it works with you as the buyer when you buy a house. And if you have any additional questions, in this case, the best option is to call Kelly, because she's the expert. So, her information is down here. She definitely can explain how everything works. And if you are looking to obtain a pre-approval, not a pre-qualification, or even fully underwriting approval, she can help you with that as well. Which, by the way, fully underwritten approval, it will make you a stronger buyer
Yes.
at any point. So if you are able to do that, I would definitely recommend, if you are a person in the market right now and your lender, if your lender don't offer that right now, talk to Kelly.
Yes.
She can help you.
You do, and it all depends on your situation. There are some people that, they just want to hit the ball running, and when they find the house that they want, um, that most likely they would probably win the bid because they actually had the actual approval in their hands. Now our pre-approvals are very close to that, but an underwriter hasn't actually looked at the file.
Yeah.
So
That's right.
So that's the difference.
Awesome. Well, thank you so much, Kelly, for giving us so much insight. That was very, very helpful. Even I learned something new today. So that's good. Hopefully you guys there also learned a lot from us today. And we'll see you next week.
Yep.
Thank you, Kelly.
Have a great week.
See you guys.